The Federal Reserve just made a decision that is going to quietly, slowly, but very powerfully reshape what your savings are actually worth. 5 years from now, you're going to look back and realize that this moment, right now, was the turning point. And either you understood what was happening or you didn't. So let me ask you something. Do you actually know what the Fed just did? Because I promise you, most people have no idea. And that gap in understanding, that's the gap between people who build wealth and people who wonder why they can't seem to get ahead. What the Fed actually is and why most people get it wrong. Before we talk about what just changed, we need to make sure we're on the same page about what the Federal Reserve actually is, because there is a massive amount of confusion about this, even among people who consider themselves financially literate. The Federal Reserve is the central bank of the United States. It is not a government agency in the traditional sense, but it operates under a congressional mandate. Its job, officially, is to pursue two goals: maximum employment and stable prices. That's called the dual mandate. Everything the Fed does, every single decision it makes, is theoretically in service of those two goals. The most powerful tool the Fed has is the federal funds rate, the interest rate at which banks lend money to each other overnight. Now, why does an overnight lending rate between banks matter to you? Because that rate is the foundation of basically every other interest rate in the economy. Mortgage rates, car loan rates, credit card rates, savings account rates, they all flow downstream from the Fed funds rate. When the Fed moves that rate, everything else moves with it. Not always immediately, not always by the same amount, but it moves. So when people say the Fed raised rates or the Fed cut rates, what they're really saying is that the Fed just turned a dial that influences the cost of money across the entire economy. And the cost of money determines how people spend, save, invest, and borrow. It affects corporate profitability. It affects housing markets. It affects whether you're being rewarded for keeping money in a savings account or being punished for it. This is not some abstract Wall Street concept. This is the most direct lever anyone has over the financial reality of everyday Americans. And right now, that lever just moved. What just happened? The decision that changes the game. Here is what the Fed just did, stripped of all the jargon. After a period of historically high interest rates, rates we hadn't seen in over 2 decades, the Federal Reserve has signaled a clear pivot. A shift in policy direction. The era of aggressive rate hikes is over, and the question is no longer whether rates will come down, but how fast and how far. Now, to understand why this is significant, you need to understand where we came from. Back in 2022, inflation in the United States hit levels not seen since the early 1980s. Prices were rising at over 8% annually. The cost of groceries, energy, rent, cars, everything was going up faster than wages could keep up with. The Fed, which had kept rates near zero for years to support the economy through the pandemic, had to act. So they hiked. Aggressively. They raised the federal funds rate from near zero all the way up above 5% in one of the fastest rate hiking cycles in modern history. The goal was simple: make borrowing more expensive, cool down demand, bring inflation back to the 2% target. And it worked. Kind of. Inflation came down significantly from its peak, but the side effects were brutal. The housing market froze because mortgage rates shot above 7%. Small businesses struggled to access affordable credit. Consumers started feeling the weight of high interest on credit card debt. And through all of this, savers, for the first time in years, were actually getting something back. High-yield savings accounts were offering 4, even 5%. CDs were attractive again. Treasury yields were giving real returns. That era is now ending. The Fed has begun cutting rates, and the trajectory is clearly downward. And that changes everything for your savings strategy. The savings account trap. Nobody is warning you about here is the thing that nobody is talking about loudly enough. If you have been sitting in a high-yield savings account or a money market fund over the past couple of years, congratulations. You made a smart move. You were getting paid to be safe. That was genuinely good advice for that environment. But environments change. And the mistake most people make is fighting the last war. They keep doing what worked yesterday, not realizing that yesterday's strategy is today's opportunity cost. As the Fed cuts rates, banks will lower the interest they pay on savings accounts. This has already started. 6 months ago, you could find savings accounts paying 5%. Today, those same banks are offering 4, 3.5, 3%. In 12 months, we could be looking at 2%, maybe less. The math here is not complicated. If inflation is running at 2.5% and your savings account is paying 2%, you are losing purchasing power every single day. Your balance is going up in nominal terms, but in real terms, in terms of what that money can actually buy, you are moving backwards. This is the savings account trap. It feels safe. The number goes up. There are no scary red charts. But safety and security are not the same thing. A savings account that doesn't keep pace with inflation is not protecting your wealth. It's slowly eroding it in the most comfortable way possible. Now, I am not saying get out of savings accounts entirely. They serve a purpose. Your emergency fund absolutely belongs in a liquid, safe account. 3 to 6 months of expenses, keep it there. Don't overthink it. That money needs to be accessible and it needs to be protected. The rate you earn on it is secondary to its actual function. But everything above your emergency fund, that is where this conversation gets really interesting. The ripple effects across every asset class. When the Fed shifts policy, it doesn't just affect savings accounts. The ripple goes through every major asset class, and understanding those ripples is how you position yourself intelligently. Let's walk through each one. Bonds. When interest rates fall, bond prices rise. That's not a coincidence. It's pure math. Bonds that were issued at higher rates become more valuable when new bonds are being issued at lower rates. So if you have exposure to bonds or bond funds, a rate-cutting cycle is generally good news. The caveat is that this is already being priced in by the market, meaning the easy money from this trade may already be shrinking. But longer duration treasury bonds and investment-grade corporate bonds still have room to appreciate as rates continue to fall. Real estate. This is the one everyone is watching. Mortgage rates are tied closely to the 10-year Treasury yield, not directly to the Fed funds rate, but they move in the same general direction. As the Fed cuts, mortgage rates will gradually decline. This means affordability improves. More buyers re-enter the market, demand picks up. In markets where supply is constrained, which is most major metropolitan areas in America. Rising demand with low supply means rising prices. If you've been waiting on the sidelines for rates to drop before buying a home, you need to understand that when rates drop, prices typically rise. The window where both rates and prices are favorable may be narrower than you think. Stocks. Lower interest rates are generally positive for equities, for a few reasons. First, they reduce the discount rate used to value future earnings, which mechanically increases valuations. Second, they lower borrowing costs for companies, which can boost profitability. Third, they push investors out of safe assets like savings accounts and into riskier assets like stocks, as the return on cash becomes less attractive. However, and this is important, the stock market is also a discounting machine. It tries to price in the future before it happens. Much of the benefit of rate cuts may already be reflected in current stock prices, particularly in growth stocks and tech. Gold and hard assets. Historically, gold performs well in rate-cutting environments, especially when real rates, that's nominal rates minus inflation, are low or negative. If the Fed is cutting while inflation remains stubbornly above target, real rates could stay suppressed for an extended period. That is historically a strong environment for gold and similar stores of value. What smart money is actually doing right now? So with all of this context, what do you actually do? Let me tell you what the sophisticated, long-term oriented investors are thinking about right now. Not what they're screaming about on financial Twitter, but what they're quietly doing with their portfolios. First, they are locking in yields while they can. If you have cash that you know you won't need for 1, 2, or 3 years, there is a strong argument for moving it into longer duration instruments right now. Treasury bonds, CDs with longer maturities, I bonds, before rates fall further. This is called duration extension. and it's a way of guaranteeing yourself a higher rate for longer. Once the Fed has cut multiple more times, this opportunity will be gone. You'll look back and wish you had locked in 5% for 2 years when you had the chance. Second, they are reassessing their stock exposure with a fresh lens. The rate environment affects different sectors differently. Utilities, real estate investment trusts, and dividend-paying stocks tend to benefit more from rate cuts than growth stocks, which are already priced for perfection. If your equity portfolio is heavily concentrated in high-multiple tech stocks, a rate-cutting cycle doesn't automatically bail you out. Those valuations are already stretched, and if earnings disappoint, the market will not be forgiving. Third, they are thinking about the dollar. When US rates fall relative to other countries, the dollar tends to weaken. A weaker dollar is good for international investments. When you convert foreign returns back to dollars, you gain an additional tailwind. This is one reason global diversification is being talked about more seriously right now. International developed markets and select emerging markets look increasingly interesting relative to the US on a valuation basis. Fourth, they are watching credit spreads. As rates fall and liquidity improves, corporate bonds, especially investment-grade ones, tend to perform well. Some sophisticated investors are rotating from pure cash holdings into short and medium-duration corporate bonds to capture additional yield without taking on significant risk. The inflation risk. Nobody wants to talk about here is the uncomfortable conversation that most financial media is avoiding because it's not clean and it's not easy to package into a positive headline. The Fed is cutting rates, but inflation has not fully been defeated. It has come down from its peak, yes, but it has been sticky. Core inflation, which strips out food and energy, has remained above the Fed's 2% target for longer than most economists predicted. And the Fed is cutting anyway. Why? Because they're also watching the labor market, because they're worried about the economic slowdown, because there is political pressure, always, to keep the economy humming, because central banks are human institutions run by human beings who are making judgment calls with imperfect information. The risk is this: if the Fed cuts too aggressively while inflation is still running hot, they risk reigniting price pressures. We could end up in a situation where inflation stabilizes above 2%, not falling back to target. And the Fed is stuck, unable to cut further because it would worsen inflation, unable to raise because it would crush the economy. This is called stagflation, and it is the worst of all worlds for savers and investors alike. In a stagflationary environment, cash gets destroyed, bonds underperform, and only real assets, things like real estate, commodities, and inflation-protected securities, hold their ground. This is not the base case, but it is a risk worth sizing in your portfolio. Having some exposure to inflation-resistant assets, whether that's real estate, tips, commodities, or even a small allocation to gold, is not pessimism. It's prudence. The psychological trap that will cost you. I want to spend a moment talking about something that is not on any balance sheet, but is arguably the biggest risk to your financial future. And that is the psychological trap of financial inaction. Here is what happens to most people. They hear news like this: the Fed changed policy, rates are going down, things are shifting. They feel a vague sense that they should do something. Maybe they Google it for 5 minutes. Maybe they watch a few videos. And then life happens. Work, family, stress, distraction, and they don't do anything. The account stays exactly where it was. The strategy doesn't change. 6 months pass, a year passes. And slowly, quietly, the opportunity costs compound. The money that was earning 4% is now earning 2.5. The bonds they could have bought at peak rates they never bought. The equity positions they wanted to diversify into, they never did it because there was always a reason to wait. This is not a character flaw. This is human psychology. Our brains are not wired to respond urgently to slow-moving, abstract threats. We respond to immediate, visible danger. Not the gradual erosion of purchasing power over years, but the financial world doesn't care about how our brains are wired. It just keeps moving. The antidote is not to become some obsessive portfolio checker who trades every day. The antidote is to make a decision now, while this information is fresh, and to act on it. Even a small action, moving money into a longer duration instrument, opening a brokerage account you've been putting off, rebalancing a portfolio that hasn't been touched in 3 years, is infinitely better than perfect inaction. Sora, building a rate adaptive portfolio for the next 5 years. Let me give you a practical framework for thinking about your money over the next 5 years in a world where rates are declining from elevated levels. Think of your money in three buckets. Bucket one is your liquidity bucket. This is 3 to 6 months of living expenses. It lives in a high yield savings account or money market fund. You don't optimize this aggressively because it's not meant to grow. It's meant to be there when you need it. Accept the declining rate because the purpose of this money isn't return. It's stability. Bucket two is your medium-term bucket. This is money you might need in 1 to 5 years. A down payment, a major life expense, a business investment. In a declining rate environment, this money should be working in instruments that lock in higher rates before they disappear. Series 1. Bonds. Treasury bonds with 2 to 5 year maturities. CDs. These are your tools here. Stop leaving this money in a savings account when you have options that pay significantly more for the same or similar risk profile. Bucket 3 is your long-term wealth bucket. This is money you don't need for at least 5 years, ideally 10 or more. This money should be invested in a diversified, low-cost portfolio that gives you exposure to equities, real assets, and bonds, in a way that is designed to outpace inflation over long periods. The magic here is time. The math of compound growth doesn't care about what the Fed does in any given year. It cares about years and decades, but you have to actually put the money to work to benefit from it. This three-bucket system is not revolutionary, but most people don't have it. Most people have everything in one account, unclear on what it's for, earning whatever rate the bank decides to give them, never reviewing whether that's appropriate. That's not a strategy. That's financial drift. The one number that tells you everything. Let me leave you with one concept that should change how you think about every financial decision going forward. The number is your real rate of return, not your nominal return, not the 4% the bank says you're earning. Your real return, which is that number minus inflation. If your savings account pays 3% and inflation is running at 2.5%, your real return is 0.5%. That's it. That's what your money is actually gaining in purchasing power terms, 0.5%. If your account drops to 2% because the Fed has cut several more times and inflation stays at 2.5%, your real return is negative 0.5%. You are losing money in real terms even as your balance grows. This single number, your real rate of return, is the most honest measure of whether your financial strategy is working, not your account balance. Not the nominal interest rate the bank advertises, the real return. Get in the habit of calculating it. Get in the habit of asking, for every dollar you have sitting somewhere, what is this money's real return? What is it actually doing for my long-term purchasing power? If the answer is basically nothing or negative, that is a signal, not to panic, not to make rash decisions, but to take the question seriously and explore whether there's a better option available to you. The Fed just changed the landscape. The rules of the game, the specific rates, the specific yields, the specific opportunities, they've all shifted. The people who understand those shifts and adapt to them will be in a fundamentally different financial position 5 years from now than the people who don't. You now understand what happened, you now understand what it means. The only question left is what you're going to do about it.